Welcome back to another episode of 101. My name is Jill Franks, and I'm the marketing director here at Farmers State Bank.
Hello, I am Ashley Sticker. I am the assistant marketing director here at Farmers State Bank. We're so glad you guys are here, and we are ready to answer some questions about USDA loans today. If you have any questions, please put them in the comments, but we've got a lot for John, so we're going to get started here. This is John Streuter. If you want to go ahead and introduce yourself too.
Welcome everybody once again to our Mortgage 101. Glad to be here.
Awesome.
We're going to jump right into this, John. I know we've done a couple of these episodes before, so I think it's time to get down to the nitty-gritty. But I would like to, and I think everybody else that is on would like to have a quick update on what is going on in the mortgage world right now.
Great. Yeah, and I'm excited about today because the program that we have is called the USDA program. It's a fantastic program for first-time home buyers and probably the most heavily used program for first-time home buyers. With regards to the market, I've been doing this 36 years and haven't seen the market as crazy as it is right now. Interest rates are at an ultimate low. They are a little bit higher than the lowest level, but from a buying standpoint, they're as low as they've ever been in 60 plus years. There's not enough homes in the marketplace, so we have more buyers than we do sellers right now, and that's causing for a very hot market. Most of the agents are getting listings or getting sales within 1 to 2 days of listing a piece of property. So the biggest thing is for buyers to get pre-qualified, and that's what this whole Mortgage 101 is all about, is to give education to buyers, let them know what they need to do to get pre-qualified, let them know what programs are out there that can get them into a home.
Wow, I can't believe that homes are going in that short a period of time. That just seems crazy to me.
It wasn't probably 3 years ago that the average time on the market was almost 6 months. The average time on the market right now is less than a week.
Wow.
And people just can't. The only homes that are not selling right now are homes that need too much work, and people don't have the funds to do construction. But we're even seeing some of those homes. I've done more what we call purchase rehab loans than I've done in a long time, where people are purchasing the home and getting money to rehab the home.
Yeah. Wow. I can't believe it.
And even as with construction prices as high as they are, we're doing as many construction loans as we've done in a long time. So between Polly and we probably both have 30 loans under that are in construction right now. So, and that's not even counting what Taylor has in Harrisburg or Tom may have in Alto Pass. So I'm just looking at the Marion market.
Yeah. What do you see? Do you foresee?
Another great thing that I should say is Farmers State Bank is #1, and we continue to lead the market in mortgage recordings and mortgage business. So there's no better place than to come to Farmers for your mortgage.
Absolutely. John, do you foresee this continuing the way it is, or do you have any insight you can give us about the future, or this summer, later this fall?
Sure. What we're seeing in the marketplace from trends that I watch and agencies that I listen to, we expect 2021 to remain strong. Where the bubble is going to be is whether the Fed happens to manage the transition to higher interest rates and inflation. And inflation is starting, especially with construction costs, we're seeing inflation starting to set in. So the Feds will do some things to try to dampen inflation by raising interest rates, but they don't want to raise interest rates that stop the economy. So that'll be the interesting thing to watch in 2022, is how they move that dynamic, and whether you don't want to raise rates such that it creates a drop in the market just to bring inflation down. But we can't have runaway inflation either. But right now, 2021 is the perfect time for people to, take advantage of it right now. We really don't know where the market will be in 2022, but for the balance of this year, everybody's expecting a strong finish.
Yeah. John, do you think that the construction costs are so high because of the manufacturers being shut down from COVID? Is that the reason?
There are a number of factors. One factor is that COVID caused a lot of timber workers to be off. So there wasn't as much timber harvested. So there's a shortage of timber out there. Two, the people that do all the sawmills and that production of the wood process was backlogged due to manufacturing being shut down over the COVID period of time. We always have the issue with fires out west and some of the areas that have a need for a high supply of materials to come back from different disasters. So right now, it's kind of, I heard somebody say that I was talking to affiliated with one of the lumber companies, that it's kind of a perfect storm. We have any one of these things typically in a year causes prices to increase. We have multiple where we have a shortage of supply because of not enough lumberjacks out there cutting down the wood. We don't have enough supply because the mills aren't kicking out enough supply. And then we have some of the disasters that's putting a high demand on supply. And then we have more buyers than we do sellers. So we have more people needing to build homes because we have a lack of homes. So that's the thing. It's not one issue. It's a perfect storm of multiple issues that's causing such a dramatic increase in the materials market.
So do you think next year, we're just guessing around here, is it going to flip-flop? Or are more people going to be building homes, say magically all these prices come down, and then more people are going to be doing new construction and less people are going to be buying homes?
Well, unfortunately, the way we always see it in the residential market is we never really see prices drop. And to see prices drop means that there's going to be a collapse in the market, which we really don't want. So we kind of see this is the base for where prices are these days. So to build a home now, instead of $125 a square foot, it's now going to cost you $175 to $200 a square foot. And we probably won't ever see prices come down unless there's a collapse in the market. Likewise, with home prices, we won't see home prices come down unless there's a collapse in the market. And we hope to avoid that. But we are kind of creating that bubble again. And I was talking with somebody in the financial markets, and they said, yes, we're creating a bubble. But I was watching a webinar on this whole issue. And they said, the gentleman that was talking about it said, the one difference from now and 2008 is government's a little bit smarter. There are a little bit more controls on lenders, but we don't have as many of the Wall Street banks involved in the mortgage business as they did in 2008. So there's a little more sanity in the mortgage market. So we are kind of creating a bubble. There probably will be a burst of that bubble in the next 5 years. But it probably won't be and shouldn't be the financial collapse that we saw in 2008. So again, I think 2021 is the perfect time for people to be getting into the housing market, because I don't really think, I've had a couple people say, well, we're going to wait for our prices to come down. And I don't think prices will come down. I think we're setting a new base level here.
New normal.
Right, a new normal. That's a good way to put it. I think we have a new normal, and the price of a good hamburger is now almost $10 instead of $5. So
That wild.
It's just the way it's going to be.
Crazy. Well, thank you for the update. We are going to jump right in. So, John, go ahead and tell us what the USDA Rural Development Loan is.
Okay. USDA is the Department of Agriculture, and people will say, well, what's the Department of Agriculture doing in the housing business? They got started in the housing business many, many years ago. They were primarily helping rural communities that had farm homes and people wanting to develop those communities with financing. So they were in past years heavily part of the agriculture market and helping farmers get home loans. They have moved into, and now this program is called USDA Rural Development, and it's still to help develop rural areas. So the big question that many people always ask is, well, does that mean I have to buy a house in the country? Absolutely not. For the federal government, rural is considered anything of any area population level of 35,000 or less. So they're not looking, when we in Southern Illinois call rural, we're looking at small communities, farming communities. The government's looking at a rural area as being anything with a small population that doesn't have a metropolitan area within 30 minutes. So we're between Paducah, Cape, which are very small communities. We're between Evansville and St. Louis. So everything in Southern Illinois south of Interstate 64, with the exception of the Belleville market, is considered rural area, and we can do a rural development loan. The great thing about the program is it's 100% financing. You don't need a down payment. So rural development was their charge from the government is to provide housing and affordable housing in rural markets, and in that ability, we can offer a customer a loan with 0% down that's backed by the federal government.
Can I ask you a question? What if I want to give you a down payment? Is that allowed?
You can. A lot of people don't realize it, and a lot of banks don't promote it. But before you do that, what I'll do is I'll discuss with you, do you want to put the money down, or do you want to hold back the money and do some improvements to the property? So I'll kind of counsel them and say, do you need to paint? Is the house going to need some carpet? Anything of that nature. I will encourage you first to hold that money back and possibly do some improvements. If somebody says, well, I've got some money that I can do that, but my grandparents for a wedding present has given me $5,000. Can I put that towards the loan? Absolutely. We can use that to cover closing costs. We can use that as a down payment on the loan. You don't have to finance 100% of the purchase price. You just have the ability to finance 100%. It's a great interest rate. So even if somebody does have a little bit money down, it's still a very good program for us to take a look at.
Awesome.
I know we kind of just mentioned some of the benefits of the USDA loan, but why would I want to use a USDA loan?
A couple of reasons. One, you don't have funds for down payment and may not have funds for closing costs, but you have great credit and you have a good source of income. So you want to get a loan program. So it is the only program out there other than the Veterans Program. It is the only program that offers 100% financing. FHA, as we talked about last month, requires 3.5% down. Other first-time homebuyer programs require 3 to 5% down. So that would be the first reason, is lack of funds, and we can help you. We can't. You do have to have your own closing costs, but I can help you structure your offer with your seller in order for the seller to pay your closing costs, to where you can literally get into a home without any money out of your pocket. Second reason would be is, again, you're a first-time home buyer. You do have some credit built up, but you don't have a massive amount of credit built up. USDA does allow us to work a little bit more closely with borrowers that don't have a strong credit file. They do have to have some credit established, but they don't have to have an insurmountable amount of credit established. There's probably, it does work like any traditional mortgage loan. It's better than FHA because the government guarantee fee that is charged is cheaper than FHA. So if somebody was recommended FHA, if we can do USDA, it's a better program. The biggest item though is just the ability to get into a home with 0% down. Because one of the things that I'll have is over the years I've had borrowers come in and say, I've got good credit, I can cover the closing costs, and I've got 5% down. And then I'll see if they qualify for the USDA program, and I'll say, okay, this 5% you'll have invested in your home, that's fine, but here's your payment on a 95% conventional loan. Here's your payment on USDA. Because you're financing over 30 years, the difference in payment is very, very small. And then I say, you can use this 5%, let's call it a $100,000 piece of property. I said, that $5,000, you can paint your house, get some new carpet in the house, or you can put it against the loan and have a slightly smaller payment. So many times I'm convincing borrowers that have 5% down to go USDA so they can do the improvements to the home. Too many times I've had borrowers that did the 5% down, and then 2 months later they come in and they say, okay, now I need that home improvement loan so I can do all these improvements. So I've learned to recommend to them before to take advantage of this USDA loan.
Awesome. I know you mentioned closing costs and that. And I know, is it the same typical closing costs on a USDA as it would be a conventional loan or FHA?
Oh, yes. Now, some lenders, if you go to a Quicken or one of these internet lenders, they will try to overcharge you with inflated costs. Here at Farmers, we don't. The closing cost for a USDA program is no more than the closing cost for a conventional program. And how we can get the seller to pay for that is, again, we'll use the $100,000 situation. You have a $100,000 home. Typically, your closing costs are going to run about $1,900, and then you're going to have your first year of insurance, which is going to be $1,500 to $1,800. So I'll tell borrowers, offer your seller $103,500, and then ask the seller to cover your closing costs. The seller or cover $3,500 of closing costs. The seller's going to net the same amount of money, but now you've built in your closing cost into the loan, and you can get into the property without any money down and no money out of your pocket.
I see. It's interesting.
Does it take longer to go through the USDA program?
Any government program, VA rural development and FHA or USDA, that's another thing is you'll hear many people say USDA, some people say rural development. It's actually USDA rural development is the entire framework, or they even have a name, Rural Housing Service, so you'll hear RHS as well. But any government program is going to require a little bit more time. Because you do have some additional steps. We do have to send the package to USDA for them to do a compliance review. So there are going to be some additional steps. But we're still closing our government loans within 45 to 60 days. So typical time period is 45 days. And then if we run into some holdups with the appraisal or title work, or if USDA or VA is backlogged on files, that might cause another week or two delay. But we're not seeing any closings over 60 days.
So the most important thing for home buyers is when they come to the bank to have all their documents ready, correct?
Yeah, and that again is a good reason to work with a good lender and a good lending company that knows how these programs work. So I've been doing these loans for 36 years, and I know the government programs backwards and forwards. So when you sit down with me, I'm going to give you an entire list. here's all the documentation that I need for this program. The government just like any government program, they are very document heavy. So there are a lot more documents, a lot more verifications, and we have to get through that process and get it done as quickly as possible. And that's where some lenders get astray, is they take the normal conventional package and then they send it in, and then their underwriter says, well, you're missing this, or you forgot to get the tax returns, or you didn't get the verification of employment, and then that's always dragging things out. We're going to get we know what we've got to do, and we're going to get all that done up front for them.
So what are some extra, we'll just say, documents that you wouldn't think maybe you had to have for a USDA loan?
Sure. Great question. USDA is going to require us to do a written verification of employment with your employer. That's very seldom the case with any other loan program.
Okay.
So we have to get your employer to cooperate, and sometimes employers aren't, because it's not something they get on a regular basis. They'll get the form and set it on their desk and forget about it. So we tell our borrowers up front, we've got to get this written verification of employment. Be sure to tell your employer they're going to be receiving it and that they need to get it processed as quickly as possible. We have to get tax transcripts for their tax returns. So that's a special form that we have to get signed, and we have to inquire with the IRS to get what's basically a copy of their tax return. And they say, well, I'm handing you my tax returns. Why do you need to get a copy? USDA and FHA and VA, again, are all about duplication and re-verification. So they're going to say, okay, it's great that you gave us your tax returns, but now we want the IRS to verify that those were the tax returns that you filed. So we're constantly having to re-verify information. So that's another thing. And with the IRS, that's something that can take 7 days, and sometimes it's taken 3 weeks to get tax transcripts, and that can really hold up the process. With USDA, sometimes we have to get a rent verification. So if you do have a limited credit, many times they want us to get a rent verification because you are a first-time home buyer. You don't have any mortgage credit out there. You just have credit cards and car loans. They want to see what kind of housing payment you've been making. So that's another form that we have to get your landlord to cooperate with. So those are the biggest ones. Whenever there's a divorce, we have to get divorce papers. And another thing that's a big issue with USDA is we have to calculate the household income. So we may have to, if you've got an 18 or 21-year-old living at home that's working, we may have to get pay stubs and income verification from them to determine what the household income is. One of the drawbacks with USDA is that it is based on household income. Because it's rural area, one of their other qualifications is you have to be a borrower of moderate means, and they have an income qualifier for that. For a 1 to 4 family household in our market, the household can earn up to $90,000 and still qualify. So for us, that seems to be a very high threshold. If it's 5 or more in the household can earn $119,000. So we have different qualifying things. You have household, so we have to make sure that household, everyone in that household bringing income, that income into the household is less than $90,000 for a 4-person household. Then we have qualifying income. Qualifying income is the income that we use from just the borrowers, because naturally an 18-year-old child isn't going to be a borrower on the loan. So we don't have to use their income for qualifying, but we do have to use their income for household purposes. Another thing is we may have to qualify if somebody has a job on the side, or one that we've seen recently that really mucked things up for us is the borrower borrowers are now starting to sell things on the internet. And if they just sell one or two items, that's fine. But if they're doing it as a sideline business where they have monthly income coming in, we have to verify what type of things that they're selling and how much income that they're bringing in to see if that gets them over that that household income figure. So bank statements is another big document thing with USDA. We have to verify any employment income. So if you're making a $500 deposit here, $200,000 or not 100,000, $200 deposit here, $100 deposit there, we have to verify the sources of all those deposits, because USDA wants to make sure that you're not generating income into the household that you're not reporting.
Wow.
Under all other programs, we cannot ask you if you have any child support or maintenance income that you want to report. Under the USDA program, we do have to ask you whether you have any child support or maintenance income that you need to report, or do you have any retirement income that you need to report. So any income that you're receiving, we have to put that on the application as household income for qualifying that USDA program.
Great.
I probably just blew everybody away with all that.
No, that's good. They need to know. They need to know.
If you have other questions on that, feel free to ask. Or if anybody out there has, well, what about this income? So yeah, we see that as probably the biggest problem is people making miscellaneous deposits on their bank statements. So one of a borrower that I had 3 years ago who did lawn mowing on the side, had a normal job, had lawn mowing on the side. And the crazy thing is he had 3 different bank accounts, and he didn't, we had to verify all the funds that were in the bank accounts for the loan closing. And he would move money from this account to this account to this account back into this account, and some of his lawn mowing money would go into this account one month, and the next month it went into that account. And it was a huge nightmare. I literally had a file that was, get that in the picture, was that thick. Normally a file's about this thick. And and the customer got frustrated because it was, well, what do you need now? Well, you turned in a bank statement and there's 2 deposits on that. Well, that was lawn mowing. Well, why'd you deposit in that account instead of the other account? I don't know. That was the deposit ticket I had sitting in my vehicle. So getting pre-qualified with a borrower, or I'm sorry, getting pre-qualified with a bank, especially someone like us, we're going to sit down and counsel you. Do you have any strange deposit habits? Do you have any side businesses out there? And we're going to say, these are the things that you need to do in order to make it easier when you do find the home.
So I have a question for you. You said any side income, is it up to a threshold, or it's literally,
We have to document any. What we're going to look at is we have to get your last 2 months worth of bank statements.
Okay.
And we have to document any deposits into those bank statements that are your non-payroll deposits.
Okay.
We also have to ask you, is there any source of income other than your normal job? And so, somebody could hold back and not report something. And if it's a cash business that's not going into their checking account, then, probably no one will ever know to the wiser. But it is any amount of money. I've literally had to get verification on $1 deposits because they had $1.50 sitting in their tray, and they took that to the bank in coin, and they took that to the bank and said, here, put this in the bank. And But in verifying it, all we have to do is get a deposit slip from the bank that shows it was a cash deposit. And all they have to do is write a letter or statement that says, hey, I took some coin out of the piggy bank and deposited it into the bank. So it's not like it's an FBI search, but it is a huge inconvenience.
Yeah.
So we tell customers, try to avoid emptying your piggy banks. Don't take any mattress money to the bank or anything like that. So
yes. Well, I want to know, John, do I need a USDA loan? How do I know if I need one?
Well, again, the best thing is to call us, call the loan officer and say, is this a program? So the first question is do you have any down payment money? Excuse me. If you don't have down payment money, then yes, this is probably the best program for you to take a look at. Boy, I can tell my throat's getting dry. Talking too much. You guys got to ask more questions, and I got to talk less. So that's the first question: is do I have funds for a down payment? If not, then yes, I need to look at the USDA program. Is my annual income, household income, under 90,000? If so, if the answer is yes, then the USDA program is probably the best program for you to take a look at. The second question is the home going to need a little bit of repair cost? Not any major repairs, because USDA doesn't allow for major repairs. Is it going to need some cosmetic things? If so, then I'd rather do USDA and keep the money that I have to do those improvements and get 100% financing. So those are the three biggest things that I talk to borrowers when they call me and say, can I qualify as, say, what kind of money do you have down? What kind of money do you have for down payment and closing costs? If it's very small amount, I tell them you probably want to use that for painting and window treatments and things of that nature. And then third is your income below that 90,000 household mark, then the USDA program is probably a great program for you.
So what kind of things, and we talked about this last time with the FHA loans, which surprised me quite a bit because it's really interesting. People would maybe want to fix up a house, do a fixer-upper, HGTV, all that, but you can't use a USDA loan for a fixer-upper, can you? So what are the things?
This is just like that. All government programs are the same. VA, FHA, and rural development, USDA, all look at, they don't want to lend with a government guarantee on a home that's going to require a lot of improvements. They don't want the homeowner to have out-of-pocket expenses after they buy this home. So you can't have any major improvements. The house has got to be in livable condition. It's got to be in what we call move-in ready condition. The roof can't, and this is just an appearance. There's no way to gauge a roof has 3 years left, 5 years left, or 10 years left. But from an observation, does it look to have 3 to 5 years at least left in its life expectancy? Is the plumbing up to code? Is the electrical up to code? All of those same things that we talked about under FHA are going to apply under USDA.
Okay.
I want to talk about insurance for a minute, because I know when we talked about PMI insurance in the past and things like that, what does that look like for the USDA loans? What kind of insurance is required?
So again, PMI is private mortgage insurance. That's for a conventional loan when you have less than 20% down. So anytime that you have a loan with less than 20% down, you're going to have some form of insurance, whether it's PMI on a conventional loan, MIP on a FHA loan, the VA guarantee fee on a VA loan, and then the USDA calls it an annual fee. So the Department of Rural Development calls it the annual fee. You pay 1% upfront at the time of the loan, and that can be added to the loan amount. And then you pay 0.35% on a monthly basis for the life of the loan. The advantage with the USDA over FHA is, again, FHA was 1.75% upfront. USDA is only 1%, so it's much cheaper. FHA charges 0.85% on a month-to-month basis, whereas USDA only charges 0.35. So USDA is half the cost when it comes to insurance, what we call mortgage insurance, which is completely different from homeowners insurance. The other advantage with USDA is that premium is charged on a declining balance. Each year they look at what the principal balance is, and that's what your next year's fee is based on. Whereas FHA, that 0.85 is based on the original loan amount. It's not a declining balance, it's a stable balance premium. So that's another advantage with USDA, is the fact that it's on a declining balance. Homeowners insurance obviously is going to be the coverage that you get to cover your home against any type of wind damage, any type of disasters. That's the word I'm looking for.
All right.
Well, the other thing that mortgage insurance doesn't do is it's not life and disability insurance. So many people say, oh, I've got life insurance. No, the mortgage insurance is just strictly covering that amount of down payment that you didn't have when you purchased the property.
Got it. So is this insurance, this mortgage insurance, for the life of the loan? Do I have to pay that, or is that just until, you know?
It is. Yeah, it is. That's the downside between PMI and the USDA annual fee, is the annual fee is for the life of the loan. The positive part is it is a declining balance, so as that balance is going down, the premium is going down, but it is for the life of the loan. To get rid of the premium, you'd have to refinance the loan, as we discussed on the FHA side.
Okay, thank you.
Okay, so I'm going to give you a scenario.
Okay.
So I'm not married, and say I qualify for a USDA loan. I get it, go buy a house, and in 4 years I get married and my finances change for the better, and I'm over a certain threshold. What happens now to my USDA loan? Say I keep the home.
Wonderful question. Nothing happens. With the USDA rural development, it's all based on the time of closing. So nothing, the only thing that you can't do on a USDA loan is you can't turn it into you can't turn it into rental property. If you turn it into rental property, if you got married, bought another house, but wanted to keep this for rental property, you would be required to refinance it to a different kind of loan. It does have to be your primary residence. Nothing else changes. Your income obviously could be out of the threshold, and none of that is an issue. Now, there is a different rural development program. It's called the Rural Development Direct Program, and that is with the federal government. That one, on the other hand, is a year by year. They're going to ask you to update your household information. And if your household information changes, what they're going to do is they can't immediately force you to do anything, but they're going to send you letters every month saying, we highly recommend that you refinance your loan. But what they can do is raise your interest rate. Under that direct program, that's a subsidy-driven program, and that's why they get your income each year. And even though they can't force you to sell or refinance, they will raise your interest rate based on the household income, because the interest rate was based on household income when you got the loan. So that everybody needs to realize there are two different programs out there. There's Rural Development Guarantee that is done through banks, and there is Rural Development Direct that is done through the federal government. And that program is what they call a low income program. That is for borrowers that have very low income. There are some advantages to going through that program. And if we see that your income meets that low income guideline, I'm going to give you the name and number of the rural development officer to call and say, find out if this program is better for you. If it's not, then come back and see me for the guarantee program.
Okay.
Great. So I have a question about, you mentioned, I got married, now we want to buy a second property. So can I finance my new property with a USDA loan, or you said it has to be a primary residence?
The USDA loan always has to be a primary residence, and you cannot have a second piece of property and have a USDA loan. But that gets in a real fuzzy situation. So I'll give you a better example. You're a single person. You have this home that's maybe 1,200 square feet with 2 bedrooms, 1 bath. It suits your needs just fine. You get married, but the person that you get married to has 3 children, and now you're a household of 5, and this household doesn't meet your needs any longer. So in that situation, as long as that house that you originally purchased was not a USDA program, you could, by getting married and now having a household of 5, you could buy another home and still keep that other home and use it as rental property. Now, if that home that you bought as a single person was under a USDA program, then no, you would have to refinance it or sell that in order to get a different USDA. You can only have one USDA loan. Now, in an opposite scenario, say that you as an individual went ahead and bought a house that's a 3-bedroom, 2-bath house, and now you get married, and you get married to somebody that has 2 kids. Well, let's just say you get married, a year later, you have your first child. So now you have a house with 3 people, and your spouse says, I really want a different home. In that situation, the home that you have still meets the needs of a 3-person household family. You would have to sell that home before you could finance a new home under the USDA program.
Got it.
So again, what I tell real estate agents all the time when I have this discussion, as I said, don't try to remember all these scenarios. Just think, you let the banker and let the loan officer work through the process. Tell me what the scenario is. Tell me, hey, she bought a house 2 years ago. She's gotten married. They now have a child. They want to buy another home. Have them come talk to me, and I'll find out whether the USDA program is a fit, and if it's not, what other programs would be a fit.
This is a question that I had earlier today as I was researching USDA loans is all this trend you're seeing with Airbnb properties, and people, we have this home, but we live there. It's our primary residence. And now I'm going to rent out my upstairs apartment. Would that qualify? Or I just was curious.
If you have a USDA loan already, and then again, as I mentioned in Ashley's situation before, nothing changes. USDA can't do anything if you suddenly decide, well, I've got more space than I need. I want to rent this out to a college student because I'm close to SIU. Yeah, that, as long as it's your primary residence, USDA can't do anything to change that.
So that's your loophole, kind of, for an investment property.
The flip side is, though, let's say, okay, I'm in an area where I bought a home by the lake, and I was fortunate enough to be able to buy a home and use USDA. Now I've gotten married and we've bought a home in a subdivision, but we want to keep that lake home because we know it's close to the lake and people will rent that out. That goes back to that question that I answered for Ashley before, that now you've turned it into rental property, you do have to refinance it. And how they catch it is you're going to change your insurance from primary residence to a rental fire policy. And when USDA or the lender gets notified that they're required to send you a letter saying there's been a change in the use of that home, it does require you to refinance it. Now, they're not going to start foreclosure on you. They're just going to say you need to refinance the home. Because you do sign, unlike any other program, you do sign at closing a document. It's called the USDA rider, and the paragraph explicitly says that this loan is only for the use of primary residence and that you cannot use the home for any other purposes.
And I know this is getting nitpicky, but what establishes primary residence? Is it spending a certain amount of time in that home? So say I have a house in Florida.
Well, that's where the situation would be, is you wouldn't be able to qualify for the USDA loan the first time around, is because you would have another home. So you can't have a second home or another residence whenever you finance the home for the purchase under a USDA program.
Okay.
So we usually don't run into that situation. Where I have ran into, uniquely enough, is I had a borrower who got divorced, and she now needed to buy a home. When they were married, they had their primary residence and they had a rental property. She didn't want the primary residence because it was too big and it was too expensive. So when they got divorced, he kept the primary residence, she got the rental property. She never lived in that rental property. She was living with her parents after the divorce until she found a home. We could put her into a USDA program because that house was rental property and always used for rental property. It was not her primary residence. So in that very unique situation, she could have two homes because the one had always been used as rental property.
Okay, so let's say I'm not forced to refinance in terms of all of the things and situations we've talked about. But I asked this last time with the FHA loans, would I ever want to refinance? What kind of situation would I be in that would make me want to refinance into a conventional loan, correct?
Right. Similar to the FHA, if the interest rates were such that you could get out of that annual fee, then if you could get a lower interest rate, or if you could get the same interest rate, but you have enough equity to where you could now get rid of that annual fee, that would be an advantage to refinancing that USDA loan. Uniquely, we see, probably more uniquely to any other program, we see more people stay in the USDA program than FHA and VA because it's a declining balance fee. They're seeing that fee go down every year, and the interest rates with USDA are low enough that most people don't find an opportunity to get a lower interest rate. So we see more people staying until they sell the house. Mm-hmm. That's where we see most people get out of the USDA program, is they're ready to sell the house and they have enough equity to buy another home at that point in time.
I feel like I've learned so much already on this conversation. You know, in the past, I've always been taught, you know, save that 20% down for a payment on your house. But this has really opened my eyes to see that there are so many other options available. And this is definitely a great option.
Right. It's a great way to take an opportunity of home financing.
Mm-hmm. So, John, I think all of my questions have been answered. What is the one takeaway? If somebody's viewing this, what is the one thing you want them to take away about USDA loans?
With the USDA, I think the biggest takeaway is, if I'm a first-time home buyer, this is probably the best program that I need to take consideration of, and I need to come talk to Farmers State Bank to see if I qualify for the USDA program, because it is the very best first-time home buyers program out there. I'm trying to think if there's any other takeaway, but I think that's, with this program, that's the primary takeaway. Is now, uniquely, you don't have to be a first-time home buyer. So that's another thing you should have said earlier. You can be a second buyer. You just have to sell the other home has to be sold before you can get into the new home under that USDA program. So if you're still under that $90,000 income threshold, you can use the USDA program multiple times. And there's no additional fees for using the program. You just have to have the previous home has to be sold.
Great.
Okay.
So I just put this banner up on our live stream, but why should somebody come to Farmers State Bank versus online providers?
The biggest reason why is online providers are going to steer you in the wrong direction. All online providers are going to steer you towards an FHA loan because they're on a commission basis, and that's how they make the most money, and the highest commission is by selling you an FHA loan. And they're going to do that, and they're not even going to consider the other programs. There are many online providers that don't even know anything about the USDA program. All they know about is conventional FHA and VA. They've never heard of the USDA program because they live in a metropolitan area. So they don't even know that the USDA program exists. Your local lender is always going to know all the programs that fit your market. So when you call a Quicken and they're in Minneapolis, Minnesota, I think is where they're based out of, they're not going to know anything about Southern Illinois. They're not going to know about rural development programs. They're not going to know about any type of grant programs that may be out there that can be used with these programs. And so always go to your local lender. In our market, always go to Farmers State Bank because we're going to keep you up to speed on all the programs out there, and we're going to find the right program for you that fits your needs.
Great. John, so now they know to come to Farmers. What is the best way to get a hold of you if they are interested in USDA loan?
Best way to reach me is that cell phone number. I'm always at that number. You can either call or text me and ask me questions anytime. And then my email address is up there on the banner. You can contact me by email as well.
Amazing. Awesome. Well, thank you so much for joining us.
We have online applications on our website. So the other third way is go to our website. There you go. And you can put inquiries through that as well, and that will go straight to a loan officer to give you answers to your questions.
Well, thanks, John, so much for being here today and for your valuable time. I know you're a busy man right now, so we appreciate your time and answering these questions.
I enjoyed doing this. It's a thrill to do it. I always love educating borrowers, so I hope people out there, if it's not something that you need to know about, I'm sure you have a son or daughter that's going to be in the housing market in the next few years. So hopefully these are programs that people can go on our website and click on them and learn more about financing a home.
Amazing. Thanks, John.
Thank you.
So that wraps up another Mortgage 101 with John Streuter. We're so glad that we were able to have him on today. But of course, we've got lots of other live events coming up. So be sure to tune in. When's the next one, Ashley?
The next one is next Wednesday, the 30th, with Dr. Verlinda Henshaw. It's going to be at 3 o'clock, and she is going to be teaching us how to navigate workers' compensation. So
I was surprised.
What I learned was that everybody has workers' comp. So
anybody with an employee.
Huh?
Any business with an employee.
Yes. And she has a lot of experience. She is an expert in her field, and that is why we have those people on to our Small Business Success Series. So we're so glad you're here. Mortgage 101 Small Business Success Series. We have a lot of videos for you guys out there in the community, and we love to provide these free tools for you. So
yes. Thanks for watching. We'll see you next Wednesday.